This is InvestTalk. Independent thinking, shared success.
Hello, this is Brett from California. Hey, question. I like this VITL Farms, and I think you talked about it a while back. Just wanted to see if it's still something that you recommend or something close to it. If you have another recommendation of this type of stock, I'm just looking for a good egg company that's going to be a good growth for the next 5 years. But if you give me some information on it, I'd love to hear your information on what you think about that stock. And if you have another one that you think is better, I'd really appreciate it. Thank you.
All right. VITL Farms. I used to use their eggs more than I do now, but certainly a company that's been on the rise. It's moved up from around the $11 range back in late 2023, and its recent high was around $46. Now it's trading around $34. And frankly, that's the thing that really hits me the most, is that the momentum has slowed. It's been a big, choppy consolidation pattern between that. Actually, the high was as high as 48. And then the low recently was around 28. And now we're kind of in the middle of that around 34. And it's oversold in the short term. But what I don't like about this name is not only the momentum slowing, but the fact that it's generally a commodity producer. Yeah, it's gained a lot of market share on store shelves, but egg prices are up, and so they're making more money. But are egg prices always going to be up? Probably not. In fact, earnings are expected to slow this year. Fourth quarter earnings are supposed to be down 2%, so they haven't reported fourth quarter quite yet. But this quarter, supposed to be down 15%. Next quarter, down 17%. So expectations are for the next 3 quarters, profits to start to contract. That doesn't really jive with a 30 times market multiple. Just really doesn't. So I don't like the valuations that it's trading at. I don't like the slowdown in growth. It has a good balance sheet, no long-term debt. I like that. But it's just too expensive, and the momentum's slowing, and earnings growth is turning negative. All of that, I don't like that picture, no matter what type of company it is. Now, are there others? Not really. There aren't. I don't know in the top of my head that are public egg companies. Now, there's probably ag companies that have a part of their business is in producing eggs, but no pure play egg companies, shall we say. So this is a $1.5 billion valuation, still a small cap name, but I wouldn't be buying this name. It's too expensive, and the momentum has stopped. Let's go talk to Chris in Atlanta looking at Medtronics. MDT is the symbol.
Yeah, I hold this. I know you guys were fond of it at one time. The earnings came out. They looked good from what I saw. I read through. Everything kind of looked good, looked positive for the fourth quarter. It just seemed to have a kind of a drawdown today. I didn't know if I'm missing something in the earnings that might have triggered some of that.
No, I mean, it is down on the day. So it closed on Friday around $92 and change, and now it closed the day at 86 and change. But it's really just back to the 200-day moving average. And if you look at the move, it's still up from where it was at the beginning of the year, which was right around $80. So, it's still up 7-8% on the year, which is outperforming the S&P, right? So, a lot of times you have to judge the full move of a stock kind of a month to 6 weeks leading up to earnings and after earnings. Because remember, the market's starting to discount the whisper numbers and the expectations of what they will report. And sometimes the market gets a little ahead of itself, right? Obviously, this is the case. Like I said, it rallied from 80 all the way to around 93 and change in the first 6 weeks of the year, and then had earnings today, and it gave a little bit of that back. The trends are still up, still making higher highs, higher lows. Its business is still good. So I wouldn't get too caught up in the weeds. You have to look at this in the bigger context and not just a one-day move. Would you rather have gone up? Sure. But it doesn't change the fact that it's still beating the broader market this year, and the earnings were solid. So, I wouldn't freak out about it.
No, yeah, I'm happy with it, and I have a good, good profit with it. And I was just checking, looked through, and I just saw positive remarks going into the fourth quarter, and I didn't see anything negative. I was just wondering if I might have missed something. So
no,
right, cool.
I'll say this: we did pick up this for new accounts today on the pullback. So we didn't see anything wrong with it. Same. Yep, exactly.
All right, man. Have a great day. Thanks.
No problem. Thank you for the call. Let's go take another live call. James in New York looking at REPX. Do you own it or looking to buy it?
I own it. I've owned it for some time, and I'm thinking of maybe adding to it. I've been doing well with it. Small cap, probably high risk, but I like the space, and I might want to add to it.
All right, looking at Riley Exploration Permian. So they're engaged in the exploration, development, and production in the oil and gas in the Permian Basin. The Permian Basin is where a lot of the growth in supply in the shale regions of the United States really are. And this is kind of the swing producer these days. This is those that are drilling in the Permian, and when demand goes up, they go in there and they expand their production. And so Riley is working in the right space. It's a small name, like you said, $756 million market cap. So borderline micro cap here, but very profitable, and it looks like pretty solid balance sheet, good free cash flow, about 128 million on enterprise value of about $1 billion. That's over that's about a 13% free cash flow yield. That's very good. I like that. It's certainly high risk because it is so small, but overall, I like what I'm seeing here. The trends are positive, making a series of higher highs and higher lows. It's volatile, a move from 32 to 37, and then back again in a quick order. But that's what you should expect from a name with this level of size, this market cap level. So I like it. I would hold it. Do you add a little bit more? I wouldn't mind adding a little bit more as long as it's not an extreme weighting in your portfolio.
All right. Thank you much.
No problem. Thanks for the call. Let's head over to a caller question. Not a caller question. A question submitted via the comment section over on our YouTube channel. Max Z says, hi, do you think it would be safe to hold money in something like JAAA instead of SGov? Let me take a look at this. JAAA. I'm assuming this is a AAA collateralized loan obligation ETF. So I don't know how old the person asking this question is, but collateralized loan obligation always hits back to 2008. That's a big part of the financial crisis. What this question, the person that submitted this says, I'm taking a lot more risk for the extra return. I can see far enough back to see how it would have done during the recession. Or I can't see, that's what he said. And you're right. It might have been around. Let me see if it was around. JAAA. Monthly chart here. Yeah, this only went back to 2020. So no, I mean you're going to get a little over 1% better. I don't think this is just junk, short-term junk bonds. I wouldn't get too excited about this. Not a place I would be parking cash. For more insights and resources, visit us at InvestTalk.com.
Hello, Luke and Justin. This is Matt from Minneapolis, longtime listener to the show. Thank you, gentlemen, for everything you teach us. We all appreciate it. I have a quick question, hopefully you could help me with. With rates being what they are and different policy changes right now, I own an ETF that is XHB. A lot of the housing sector area and different stocks, well, you can see there all the stuff is in that area and that. It started off doing well when I first purchased it. I have made some money in it. Now for the last, 10 months to 12 months, it hasn't done a lot, just hovered around the same area. I was wondering if this is just dead money, if I should look at putting it in something else. Let me know what you think of this ETF. Should I dump it or hang in there for a while longer and the housing sector will come around eventually? Thank you. Have a great day.
Well, this is a tough one. First, I want to start off with, I like the fact that you understand this is not just a pure play home builders ETF. This is a great lesson for everyone out there when you're looking at ETF names to know that just because it says one thing doesn't mean that's exactly what you're getting when you buy it. So this is the Spiders, this is XHB, Spiders S&P Home Builders ETF. So you would think it's filled with a bunch of home builders, and there are a lot of home builders in here. But what's its top holding? Williams-Sonoma. And we like Williams-Sonoma, but it's not a home builder, right? It sells home goods. Then you have Johnson Controls, Masco, Advanced Drainage Systems, Home Depot, and the first home builder you get to is Taylor Morrison Home. Okay? So what you can see here is it's a lot of companies adjacent to home building, but it's not pure play home builders, even though that's the name of the ETF. So that's lesson number one here. Understand what's actually in there. Now, what I will say is I actually like this better than the pure play home builder ETFs. Why is that? Because I want to own a piece of the remodeling market because so many people are locked in 3% mortgages. They're not going to sell their home. They're not going to give up the 3% mortgage, but maybe they want to refresh their home and, redo their kitchen and, buy new stuff for their kitchen and bathrooms and new flooring, etc. And they're more likely to do that, especially because they have equity. So they pull out a home equity line of credit and they're able to do that. So I like that this has a lot of exposure to the other names. For example, we've owned Williams-Sonoma for a long time for our clients. It's done very well. And so, that's one way to look at this is that you're getting good exposure to the remodeling market here. The home builders generally, I think, are still going to do fairly well. Now, there's a lot of overhang here with import costs, and tariffs, right? And so that's kind of an overhang. Near term, I don't see home builders doing fantastic. That's near term. Long term, mortgage rates come down. They'll be able to find ways to continue to make money. I still think there's more downside for home builders in the short term, so I don't like that. But I think the remodeling market is going to kind of continue to go as we talked about the boomer generation. A lot of them are locked in those 3% mortgages. They're remodeling homes. They have a lot of wealth and equity. And so I like exposure to that. So in general, I like this ETF, but I don't think home builders specifically will turn around in the short term because of those high rates. Let's play two in a row from 888-99 chart.
Hi, Justin, Luke. It's Andrew from Santa Cruz. I got a question about Sprouts, ticker Sam Frank Mike. I bought it back when it was $25 a share. 10 shares I bought, didn't pay attention to it. Now it's like $150 a share. I'm more of a dividend investor. Just curious, does this stock still got legs, or should I take the win, or should I buy more? Look forward to the answer of your question. Thank you. Bye.
All right, looking at Sprouts Farmers Market. This is another one of those names we owned a long time ago. I think we bought it in the high teens. Now it's at $171 per share. We bought it back then because it's secular growth. Sprouts sells a lot of produce and fresh foods and organic foods, and they've just really knocked it out of the park with their growth. And once again, the secular tailwinds that have been behind them. So we still like Sprouts as a company. Now, is it a bit expensive at these levels? Probably. We've been slowly trimming, up here above 150. It's at 171 now. It had a pretty decent down day, about 3%, but still that's 3% off its 52-week high. So although being down 3%, it's still, pretty elevated. To me, this is more of a time to be trimming than buying more. Once again, I don't think it's ever going to go back to the teens, but could this pull back into the 120s, 110? I think that would be a more reasonable price to pick this up for Sprouts. So right now it's just trim, hold and trim. We've trimmed slowly throughout the years. Obviously, wish we hold on to the whole lot, but that's called risk management. And so I think this is a time where you trim, not necessarily buy more. Thanks for the call. That was Sprouts SFM. Now let's pivot over and talk about underlying market right now. It's a really interesting market. S&P up about 4%, but the VIX still hanging around 15. It peaked recently around 18 and change. Historical average, though, is 19 and a half. And it shows you that the volatility of the broader index is still pretty low. But if you look underneath the surface, there are a lot of names that are up, a lot of names are down. And the volatility of the actual names within the S&P are elevated. And you can even see that with the Mag 7 overall. Collectively, this year, they're down 0.8% since January 24th when they had the DeepSeek news. But some companies are up. Meta's up 10.6%. Alphabet is down 8.2%. And so what you're seeing is an increasing dispersion of the equity market. It's more of a stock picker's market this year. That's what this is kind of saying. And more stocks are less correlated. And so there's not broad-based selling. There's not even broad-based selling within particular sectors. Wolf Research has a basket of companies that are vulnerable to protectionist policies. These are companies like Caterpillar, Hasbro, Dollar General. And you would think that they would go up and down with tariff announcements, right? That's what this index is all about. But there's also dispersion in that. So it's not like the market's treating all of them the same. Now, what is causing this? I think the main culprit here is the option market. Option deal makers are trading much higher notional value than they ever have. And a lot of it has to do with those single day options, zero DTE options that people are trading. And hedge funds are actually they're short index volatility and they're going long single stock volatility. So it's exacerbating both of those moves. But we know throughout history that tends to unwind at some point, and it likely will. Okay. One thing I want to highlight too is that just flows from 401ks, robo-advisors going into indexes, that kind of helps keep the broader index even. But when it comes to individual companies, markets will move that. Okay, and but overall, being the SP will dampen both directions, dampen the volatility in both directions. But what it shows you is that the market is carrying what's happening underneath the surface of these names and moving them in many ways, dramatic fashion. And so I don't expect this to continue. As I've said before, there's a lot of market structure issues that are keeping volatility muted. But as we saw with COVID, when there's something big enough to shake it out of that malaise, shall we say, then that's when you can get the big moves. And so I would not rule that out for happening at some point this year, especially surrounding tariffs if they are truly implemented. Now let's pivot back to the question from the InvestTalk YouTube channel. It says, are BDCs like CGBD and Maine in the category of KKR and Apollo companies with levered balance sheets that you suspect might be in trouble? Well, this is a great question. So they're called these BDC, these corporate debt companies, BDCs. And what was the example of one? CGBD. There we go. I'll type that in. So that would be Carlyle Secured Lending. So this is more private lending, private debt. And in these private vehicles, they're very similar to private equity. They're very opaque. You don't know what's in them. You don't know how they're structured. And there's a lot of risk here. And you even see with this one, CGBD, earnings are expected to decline this year by 6% and 12%. 6% full year last year, and then this year down 12%. So what you're seeing is that 9% yield, but overall that yield is not going to be supported. So if I look at CGBD, if you saw me on YouTube, if you head over to YouTube, you'll see what I'm looking at. And if you let's look at its cash dividend payout ratio. So we can see how much, so its payout ratio is 98%. meaning that it's paying out all of its earnings. And if those earnings are declining, guess what's going to happen to that payout? That payout is going to drop as well. And the market is seeing that. When you see a 9-10% yield, understand that that is the market saying that's high risk. There's a high likelihood that at some point in the medium term future, that dividend is going to change. And we're discounting accordingly. And this has already come down. So its dividend was 48 cents. Now it's down to 45 cents. In 2022, it dipped all the way down to 32 cents. So the dividend is not steady. It's all over the place. It's going to be based on the underlying quality of the credits that it's lending to. And that's what this company does. It's a specialty finance company. So it's a closed end. They have closed end funds, externally managed funds, etc. And so are they similar to KKR and Apollo? Well, KKR and Apollo are more private equity. Now, they probably private debt funds. They're a little bit more risky than the private debt funds, but they still have their problems. It was actually interesting as of late. Those KKR is down pretty nice from its 52-week high around 170. Now we're down to 140 in just a matter of 2-3 weeks. So you're starting to see some weakness out of private equity. And is this the start of the ultimate unwind of the large S around private equity and poor allocation of capital in that space? Potentially. Something I'll be on watch for. Now let's squeeze in another caller question now.
Hi, I'm calling about Ford. I'm looking to see if I should buy, sell, or hold. I have purchased it, several shares, several months ago, and the stock keeps coming down, so I keep purchasing more to average down. I also own a Ford. I don't believe that the company is going to just disappear, so I have faith in it, and I'm just wondering at what point should I stop buying more. Thank you.
Well, I don't know what a percentage of your portfolio it is, but it's usually not a good idea to keep throwing money at a company that's in a downtrend, especially a company that's in a downtrend with a lot of debt on its balance sheet. And in a highly cyclical industry, we saw in 08, right? They needed a bailout. And, will the next administration, whether that's Trump or whoever's after Trump, will they be in the mood to continue to bail out shareholders? Maybe not, right? We're in a more populist environment. I don't think that would be very politically palatable to bail out a company, even if it's, Ford. So you may like Fords, but that doesn't mean that it's a good investment. Simple as that. I see this all the time. Oh, I like the company. I don't think they're going to. Why can't Ford go away? Just because they were bailed out once? Easily could. Any company with a lot of debt can easily go away. And so I wouldn't be on, we don't own this. The car business is notoriously a terrible business to be in. It's very low margin. It's highly capital intensive. It's very cyclical. And it's just not a great place to really allocate money. It's interesting. It's more consumer facing. So a lot of people, try to, invest in car companies. But I much rather own like auto OEM manufacturers, things that they sell to Ford to build their cars, for example. So no, I wouldn't be owning Ford. I think you're throwing good money after bad.
Thanks for joining us.
If you found this helpful, please hit the like button and subscribe for more future videos.
Now let's go pivot over to a YouTube question. Corey Holbrook says, thoughts on ticker symbol AES? Am I catching a falling knife buying here, or is it a good time to buy for the long-term hold? Looking at AES Corp, and this is a large utility company, $7.3 billion market cap. Now, 7.3 sounds pretty big, but it used to be much larger. Price was around $30 per share. That was back in 2022. Now it's down to $10 per share. And there's a big reason for that. Free cash flow went deeply negative. It had been in 2021 nearly $1 billion in free cash flow. Now it's negative 5.7 billion. And you have debt that is massive. $29 billion in long-term debt on a $7 billion market cap. And this is a name that really invested in renewable energy. 53% is renewable energy. But what we've seen is a lot of times renewable energy is not very efficient, not very effective, not very cost effective. And it turns good companies into companies that just burn capital. And in the age of Trump, I don't know if they really have a future going in that direction. And a name like this, with so much debt, in a deep downtrend, relative strength is 7, horrible. It's not a name that I want to own. That dividend is likely going away, and that's what the market is telling you here. And so I think this is a zero. I think this company probably eventually goes bankrupt. So I think you are catching a falling knife. Now, could I be wrong? Absolutely. Could they turn around their free cash flow? Absolutely. Good. But as it stands today, especially with the trends in earnings expectations for this year and next year, which continue to be negative for analysts, I would not be jumping on the train. Now, it was up nicely today. Could this be a nice short-term bottom? Sure. I think that it's kind of set up for at least a bit of a bounce, maybe back up into $13, $14 range. For a trade, maybe. But as a long-term hold, I just don't like the look of that free cash flow as well as that level of debt. Now, lastly, let's talk a bit about gold. What's gold telling us? Gold's up dramatically over the past 4 months, approaching, it's at its all-time high once again today, up over 10% so far this year. And really, this is all about buying gold from places like Europe. Gold funds took in $3.4 billion, the highest inflow in almost 3 years. That's in Europe. Chinese central banks increased their gold holdings for the third straight month in January. And according to the World Gold Council, inflows into bullion-backed ETFs were $3 billion last month. And that's without the dollar really going down. So what you're seeing here is, first off, technical. It's breaking out, and people chase names that are going to all-time highs. And there's more uncertainty, geopolitically, as well as economically. And when uncertainty rises, the demand for a safe haven like gold rises as well. So I think that's the big driver here that nobody is really paying too much attention to, is that when a firebrand like Trump comes in and promises to disrupt everything, and then he starts to, for good or bad, however you want to look at it, it creates uncertainty. How is this going to go? Is this going to go smoothly? Is this going to cause major problems? And so when uncertainty rises, once again, the demand for gold goes up as well. So it's a combination of factors, but it's telling you that things are changing in a big way. We're in the fourth earning. And how this all shakes out will ultimately be told in the gold chart. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. And if you need help understanding your risk tolerance level, your risk in your portfolio, and whether you are able to reach your financial goals, I encourage you to reach out to us at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.